good afternoon. My name's Bruce Choi and I'm the Managing Director here of Research at the Global Risk Institute. So I'm pleased to welcome everyone here today for this webinar, Using Data Science to Support Real Estate Investment Strategy. It will be on GRI's sponsored project done by Professor Erkan Yonder. Now, Professor Yonder is the Laurentian Bank Professor of Real Estate and Finance in the John Molson School of Business at Concordia University. He recently completed a research piece for the Institute on using data science to support one of real estate's investment strategies in a paper titled Neighborhood Effects, Immigration and Real Estate Valuation, a Machine Learning Approach. Following Professor Yonder's presentation, I'll also invite two guest panelists to join us, and these are Dr. Andrea Chegut, Director of MIT's Real Estate Innovation Lab, and Ali Zaidi, Head of Real Assets at the London Stock Exchange. But first of all, over to you, Erkan.
So thank you very much. So today we will start this panel by my presentation on the project that we developed for GRI, which is sponsored also by the Institute. So, the title of the project is Neighborhood Effects, Immigration and Real Estate Valuation, a Machine Learning Approach. So first of all, thank you very much for this funding opportunity and for this session. So let me start quickly. So I want to start with the complexity of kind of the real estate valuation. So real estate valuation is complex due to its nature. Transactions occur less frequently. We can talk about here like years or maybe decades sometimes. And every property is unique by its own characteristics, location, and neighborhood. So this is very different from equity valuation, where we see the prices very frequently, and we have so many observable characteristics of the companies. But here, every property is unique by itself. And one important aspect of real estate, which is very related to my project, but also to ESG issues, environmental issues, or social issues, for any property, location is fixed. So, when we talk about climate effects or when we talk about social impacts, all of these aspects are based on location, and real estate is a very unique asset class to learn from for ESG activities or for climate change. But one important note here is that neighborhoods are dynamic. So although the location is fixed, neighborhoods are changing constantly over time. So if you look at the models that are mostly commonly used in this area, is like we can talk about two types of models to understand the real estate asset price dynamics. One is the hedonic pricing model, and the other is the repeat sales model. I'm not going into the technical aspects, but just to give you a sense on these models. For instance, in the hedonic pricing model, we have the characteristics of the assets, and we kind of try to calculate the value added of each characteristic. So we try to calculate the price impact of each characteristic on the asset value. And in the repeat sales model, the model benefits from the fixed characteristics of real estate. And in this type of models, we need to have multiple transactions at different times for the same property, so that keeping the characteristics of a real estate constant, we can look into the price change from one time to the other, and then we can understand the price dynamics. But these models have some issues. These models suffer from unobservables. And what do I mean by unobservables? In modeling property prices, most empirical analysis ignore some quality indicators that are only observable by net time. Yeah. So, there are some characteristics that we see, but we don't see in the data sets that we have. And in these types of models, all of these unobservable aspects are kind of ignored in valuing real estate assets. So there are three potential approaches to solve this kind of omitted variable problem, or these unobservable quality problem, which are recently developed in the literature, or mostly focused recently. So we can do some textual analysis. So in the housing market, if you look at the academic literature, especially, you'll see that there are some textual analysis looking into the brokers' tags that are put on the websites, on the real estate agent websites. And we can do some textual analysis on these and try to get some quality indicators that are not observable in our data sets and benefit and improve our valuation models. And if I try to convert this into the commercial market, I didn't see any papers. Maybe that could be a good idea, but that's a difficult data set. we can look into offering memorandums, right, in the commercial space. I mean, those are very long documents describing commercial real estate assets, and maybe we could do some textual analysis on those and try to get some information that is not available in the typical data sets. Okay, so that's number one. Number two is like focusing on property images. So Andrea and I are the product of Maastricht University, and Thies Lindenthal is one of our PhD friends. He's right now at Cambridge University in the UK. So Thies made some studies on this property images. I mean, one thing you could do is you could focus on the images of a specific property. In Thies study, Thies looked into the Google images, trying to understand the quality of the real estate assets, again, that are missing in typical databases. So what we do, or what I do in this project, is that we say, okay, neighborhoods are dynamic, but these are ignored. So there's a very big data set out there. You know, real estate is kind of slower than the typical main financial markets, but there's a very big data set out there based on the neighborhoods, and we can benefit from these neighborhood data sets. You know, and what do I mean here? Is this standard models, standard econometric or statistical models using many transactions, pooling them and trying to model real estate prices. They just use an indicator, 1-0 indicator. So if one property in the specific zip code, or if one property is located in downtown Toronto area or not. So we use this location dummies or 1-0 variables to understand the locational dynamics, but they don't represent any information related to the neighborhood surrounding or neighborhoods in these locations. So what are the factors that drive the prices in Toronto, or like the value added in Toronto downtown? We don't look into those. We just use one indicator, Toronto downtown, and we try to estimate the value added based on that. But there's so much going on in the neighborhoods, and you know, we ignore these. I mean, the typical models at least ignore it. So that was our idea. That's how we approach GRI on this project. And our project mainly focuses on utilizing neighborhood data to understand values, but of course more can be done. And I think that's one of the main topics of this panel after my presentation as well. So how can we benefit from big data in the neighborhood surrounding our real estate assets, and how we can improve our real estate investment strategy? So there are different opportunities here. One thing is that we can better understand the local characteristics and changes in the neighborhoods. So instead of saying that, you know, a typical property in downtown Montreal is like 20% more than in the suburbs, than the assets in the suburbs in Montreal, you know, it doesn't tell us much about the price dynamics or what's going on behind this 20%. Okay, so we can look into those characteristics and understand the dynamics and the factors into that, and I'll come to that in more details in the coming slides. We can improve our prediction accuracies because there is a very big data set out there. We don't use it in our valuation models, and we can benefit from these big data sets, and we can improve our prediction accuracy. So that's very important for us. And here comes in the machine learning model, and I'll come to that as well. And we can develop benchmarks. I mean, once we understand the dynamics, the neighborhood factors that are affecting value, or that are affecting environmental impacts, or that are affecting social impacts, we can develop benchmarks, and these benchmarks can help us to make better investment decisions. I mean, in this project, we don't look into social or environmental, but actually we have some social characteristics, by the way. It's more related to improving prediction accuracy. But for instance, Ali and I had a project before with European Public Real Estate Association where we focused on environmental and social benchmarks, developing an environmental and social benchmark. So we can benefit from using big data, or you know, data science, or those intensive models, mainly machine learning or deep learning models, and have such benefits as I summarized here. Okay. So the data we use here is that, what do I mean, first of all, by saying big data on neighborhoods? We can talk about points of interest data. I'll show you some example maps here. There's OpenStreetMap. This is open source. Everybody can contribute to this. So this is a growing area. I mean, big corporations like Google, Microsoft also benefit from OpenStreetMap. So it's very important, and it's a very, very fast growing network. We can benefit from census data. We can benefit from business establishment data. I mean, in this project we didn't use, but in other projects I use and Andrea uses a lot as well. We can benefit from environmental data sets, and we can develop social indicators, or we can benefit from social indicators to improve our valuation models or our understanding on ESG activities. So in this project, we use 217 additional neighborhood indicators in our model. So for our application, that's our idea. That's the data set we had when we started this project. We started with the Quebec housing data. We want to extend this project to the commercial space as well. So if you want to share any data or want to talk about it, we can discuss these also. But for this specific application, we used Quebec housing data. So this is an example, I mean, how we kind of develop our structure. So the center of this radius or this circle is an individual property in our data set. And we look into what's surrounding these assets. So in this one, we have information from OpenStreetMap. For instance, we can see other properties, restaurants, bicycle rental points, you know, gyms, banks, cafes, schools, whatever it is, okay? So our idea here is that it's not only the value added of restaurants surrounding an asset by itself, but it's the interaction effects as well. I mean, having a restaurant in the surrounding area, having offices closer to that, you know, having parks, walking areas, they have joint impacts. It's not only the restaurant itself, but there are interaction effects. And these interaction effects are difficult to capture in linear models. So that's where we can benefit from machine learning or deep learning models to capture such interaction effects. Okay, so this is, we put our property in our sample at the center and look into the surroundings. I mean, this surrounding includes data from census, I mean, the census data. This could include business establishments, which is a dynamic data set, for instance. So we try to benefit from any kind of neighborhood data we can use, and this can be improved much more, of course. I mean, we use 3-4 different data sets, but we can even use more in the setup. This is another example from OpenStreetMap. For instance, this shows the change in the restaurants in Montreal area. So we see that some places get more that some places have more restaurants by the time. So we can track all of these improvements and benefit from this information, and of course for the other amenities as well, and improve our prediction accuracy. Okay, so this is the model framework that we have. So we have the asset transaction data. So we use 3 main neighborhood data sets. As I said, this could be improved, and based on what we aim, we can use environmental data sets or social indicators and make the data set much richer. The immersive data sets, this part is important because in a typical machine learning, it's difficult to understand the factors behind the model. Okay, we can improve prediction accuracy, but it's difficult to understand. So we add an additional layer into our model where we determine the best predictors using a type of machine learning model named Lasso. So first we determine the best neighborhood predictors and then move to the machine learning approach. And the second part of the figure is more related to the machine learning model that can be applied to predict real estate prices. So this is the results, like it's selected because we have more results, but these are the best neighborhood predictors that we find using the Lasso model. So for instance, here I marked, I made it red for the immigration ones. So that's one of the main findings coming out. Maybe it's not that surprising, but in the end, it's the machine tells us that this is going on in Canada or in Quebec. So for instance, if there's higher official language minority, it's associated with higher real estate prices, non-permanent residents, external immigrants, some population, like more Arab population or Southeast Asian population, they all positively associated with real estate prices. And interestingly, there's one interesting finding. We see a negative impact of interprovincial immigration. So actually the immigration impact comes from the external immigrants coming to Canada. I think this is interesting because if you look at the literature, the impact of immigration is found to be negative on house prices in general. But we see a very different story right now in Canada. So there's only one paper by Pavlov and Somerville, I think. So they look into a policy in Vancouver which limits the immigration, and they see a decline in the house prices. So I think our study is very much complementary with their study. And here actually, it's not, we didn't start this project to say something about immigration, but it just came out by itself. And it's I think it's very interesting for the Canadian market. We see other impacts, more unemployment rate in the neighborhood surrounding a real estate asset. If it is more owner occupied, these have negative impacts, or some kind of government transfers, these have negative impacts. So 60 years and over has a positive impact, which reflects this generational transformation that we observe in this decade, or maybe in the coming years also. Density is important. From the business establishment data, if you are close to a management of a company or enterprise, you see the positive impact. But if you are close to the drinking place, you see a negative impact. And from the OpenStreetMap, we see impact of restaurants, charging stations, or kindergarten. But we have a long list, which is in the paper if you would like to look into this. Okay. So we determine these best predictors. Then we switch to how we can benefit from these neighborhood predictors. So the first model is no location characteristics indicator. It's just the property characteristics that and time effects. We estimate the model, and we find that we can explain 48% of the variation here. When we add postal codes, like one variable indicator for like this zip code and that zip code, and then this goes up to 79%. So if you drop the postal codes, but if you just use the neighborhood predictors that we show here, actually it's very closer. We go up to 76%. And it's around 100 neighborhood indicators. If you drop both, and based on what we find here, if we develop a benchmark, that's what we did in this project. And if you just use one indicator, one neighborhood indicator, and you see that it's highly significant, it has a positive impact on the value of the asset, our neighborhood benchmark. And it explains most of the variation as well. I mean, like it goes up from 49% to 70%. And it's very closer to the other impacts as well. So the benchmark actually plays a very good role. So from the third model, we can understand the impact of each individual neighborhood characteristic. And based on those, if we just create one indicator, actually we see very similar impacts using postal codes, but we don't learn much from postal codes. We just say, okay, Montreal downtown is 20% more than other places, but we don't know what drives this. So, but our approach kind of helps us understand the drivers of the neighborhood characteristics behind these type of valuations. And then if we see any change in these characteristics, neighborhood characteristics, let's say an immigration to a certain location based on our findings, you can predict the future. You can understand the future prices in those locations better than just focusing on one indicator for a specific geography. Okay? And these two figures are the representation of how this neighborhood score performs based on location. So this is Montreal area for 2017. So we see like a high evaluation at the center. So this must be downtown Montreal. And we see here, we see a little bit here. So this is based on our benchmark score. If you look into actual price, we see similar figures, similar colors, right? So there's some dense here, some here, and some here. So actually our benchmark score is very representative for the price levels across different locations. So this is just one representation of what we see here. And then finally, we do the second part of our model framework. We use a machine learning model and see how we can improve from this. So this MAPE or MDAP is like the mean and median absolute percentage error. So it gives us what's the percentage error that we make with our prediction relative to the actual price. So with standard linear models, we see 22-23% of mean percentage error. But deep learning can decreases to around 15-16%. If you look at the median, it goes down to 11%. These are reflected into something like 25-30% improvement in the error. So we can decrease the error by 25-30%. So this project is to show you that we can explain neighborhood characteristics, but if we just focus on without showing you those neighborhood predictors, if you just focus on better prediction in unreported models, actually we can go down to 7% error. So actually these models can improve can decrease the errors a lot. And I know from Zillow, they say that their median error is less than 10%. And in this project, actually, we could go down to 7% in the previous version of the project. But then we focused on developing the benchmark. But if you just focus on improving prediction accuracy, it can be improved very much by using machine learning model. And we tried different models, and in the end, we developed our own deep learning model, and it's the best performer. Just one final note on the findings. This shows the error by time. Actually, always, it's not time dependent. Always the deep learning model beats the standard linear model. So we see that improvement is always there, and you know, it's not time dependent. Okay, so to summarize, so that we can also switch to the discussion. The main idea here is that, you know, we can benefit from big data and data science a lot, and the data science can help us improve our real estate investment strategies. So in this project, we focused on improving prediction accuracy and developing a value benchmark based on neighborhood characteristics. But, you know, we can better understand the local factors beyond these valuation models and understand the dynamics of the neighborhoods. And we can focus on environmental and social benchmarks. I think maybe we can have a short discussion on that in the panel part as well. Like, I think our study with Ali is a good example to that. So we can develop environmental and social benchmarks using data science, and which could help us develop better strategies. And in this project specifically, I think our application on Quebec housing markets reflects these benefits on this specific data sets. So thank you very much.
Let's start off with Ali first, because I really want to get a practitioner's perspective. As in, how are you seeing machine learning, big data? You know, are the data scientists finding you new opportunities for you and your investment managers?
Thank you, Bruce. Thank you for the invitation. So just to put the discussion in context, I'm head of research at London Stock Exchange Group for real assets. And in terms of assets that are benchmarked to the indices, those are north of 10 trillion. However, when it comes to real estate, our area of focus remains only the listed sector. And even though that's only 15% of the overall commercial real estate market globally, it still represents close to 3.9 trillion. So that's the market we focus on. And our interactions are with asset managers and asset owners who devise their strategy through the public market. To put this, to discuss the impact of big data and technology on real estate, we have to also acknowledge that real estate is not known to be the most focused and most adopting sector on real estate. In many ways, kind of a laggard in adopting the approach that is database and research focused. So if we think about what's happening in the real estate sector, is different sectors are performing depending on how operationally efficient they have become. So a few years ago, the largest listed company in the world was a retail company. Now it is a cell tower company, and followed by data center companies. So that shows a shift towards what the real estate spectrum on the listed side looks like. It used to be very much focused on the four sectors, the RORI, the residential, office, retail, and industrial. And now we do see companies that are focused on data centers, very much on last mile logistics. So there has been a slow start, but there is wide recognition on using the data. If data is valuable, then the ability to apply that data, that real estate, commercial real estate, actually has access to a lot of historical data that hasn't been utilized. So there is recognition for that. So how we see our counterparts and our users incorporate data technology is when they're looking at specifics on asset level data. So in the traditional sense, a valuer would give you a value that's determined on backward looking values. And this used to be a very sort of a traditional method, you know, with lags and smoothing. So that is where the predominant change is taking place, where, like Erkan said, that you have to take factors into account that are readily available. Now, it's also very well understood that these factors determine the value, but the focus has now become a step further as to how do you predict those factors themselves. So, certain neighborhoods, certain restaurant concentration does impact the value, but the real challenge is to predict where these factors themselves are going to change, where the population composition will change, and how the usage will change. In addition, one of the big shifts in terms of the usage of real estate is the work from home discussion. So there is discussion around more homes becoming functional as offices, and a lot of those office buildings becoming more functional as homes. So there is this shift, which used to be pretty much about location. It's becoming more about purpose and usage. So this is where data comes into play, where I think Deloitte published a research that talks about direct digital engagement. That is giving asset owners, property owners, a lot of insights into what is the utility and experience that is being derived from their assets, and that allows them to take a lot of predictive steps in terms of reducing their vacancies, working towards the next sort of occupancy issues, and so on. So the focus at the moment is very much on two levels. One is improving operational efficiencies. So think about a logistics company that is able to work out which type of tenants are increasing space versus which ones are decreasing space, and then able to kind of look at which supply routes are more effective for those growing underlying tenants. This wasn't done before, and at the same time, we look at retail, which has grabbed a lot of headlines that it's declining, but at the same time, we also saw during the lockdown period that there was a big desire for people to come out and then congregate and come to these places that that enhance the social interaction. So there's a shift towards from the traditional retail to the experience. So then again, coming back to the idea of the purpose of an asset is just as important as its location. Um, the second level where big data is playing a big part is challenging the notion of how traditionally an asset used to be valued. Um, you know, Previously, it was acceptable to have a value once a year. That is no longer the case. Investors are interested in valuations that are more rapid, that are more dynamic, that are even on a daily basis. So when you think about an asset which is from a climate risk perspective in a unfavorable zone, that is not really a price discovery. A valuer would be able to discover that, and that it's marked down, and the cap rates would reflect that risk. The value really is how those climate zones are changing. So which one of their assets would become part of an unfavorable zone going forward in 5, 10 years versus which one would change. So I think the first step is already taken from our sort of environment where big data is being used. However, it's the next step where the challenge lies as to the predictive nature of using that data effectively. Erkan mentioned we did a project together not so long ago on ESG, and this is where the use of big data was a good example, as there's a big focus on sustainability and how to measure sustainability. Commercial real estate is an ongoing discussion, it's a debate, but it remains the core challenge there is the standardization, how one company's initiatives differ from the other, and how do you rank one over the other. So what we experimented was taking the actual capex that one company spends that could be classified as outlay towards ESG initiatives that are not directly increasing your income in that year. So some long-term initiatives. And then we were able to see that on an average, we used Develop Europe as our sample, then on average 8.3 million was spent by a company in a year on initiatives that weren't directly attributable to increasing their income in the short term. As an asset owner, that is a very valuable metric. So there are 107 companies in that sample. So if you add that up, close to 8.5 billion was spent on initiatives that are directly attributed to sustainability on ESG and don't really show up in all sorts of reporting metrics, which are very straightforward and very sort of limited when you compare the big variety of companies and their business models. So as an asset owner, if you owned all those companies, you spend 8.5 billion on sustainability, and that's a metric that's very useful because that is aligned on the long-term objectives of a lot of these asset owners. So this is where we see a big shift towards big data. Now, when it comes to, because our core
So I'm actually going to cut you off here because I want to spread the joy around. So
right.
I'm going to pass it over to Andrea because I know you've been doing some really innovative work with machine learning techniques and how the impact of street level greenery. You've been able to really study that with image technology and how that impacts price, impacts income inequality, and alpha at the end of the day. Would you like to talk about how machine learning is really becoming part of setting policy for real estate?
Yeah, and I'd like to bridge between Erkan and Ali as well, because I think for the people who are listening, so sometimes what's difficult in these contexts is that we can't see the people that we are normally engaging with in a sort of very tactile sense. And so if I was in your shoes and you would say, well, why are you listening to us talk about data science and machine learning in the context of real estate? We don't have these things. I'd say, yes, you do. You have so much data. You have so much information that is coming at you in droves. And what you're kind of missing in our industry is people who know how to do something with it. These storytellers, these data scientists, and these machine learning experts who can come up with a way of asking a question, like what Erkan has done in this fantastic paper, right? And utilizing these techniques to say, oh, how can I identify some alpha for you? Or how can I identify some environmental, social, and governance mechanisms that we can do some good in the world by listening to the stories and the experiences and the events from these transactions and these people engaging in cities around the world. So what we try to do here at MIT is teach that. So I'm very busy with trying to build a data science army. It's like a life passion of mine because I was trained. I got to take for granted that I always had data. I always had access to tons of data. And if I showed up and I said, and I was an academic and I wanted more data, they'd just give it to me. And I felt really, really lucky by that. And sort of assembling these databases and learning how to do data integration and learning how to ask these questions in a data science context has enabled me to unlock value, to take this understanding of risk and return and understand where environmental, social, and governance risks are like pressing on these real estate portfolios around the globe. And so what we've been able to do is sort of unlock those questions by building up that skill set. And so what I want to do is sort of say, if you're listening, get online, take a free class, learn some data science. It's online, it's for free. Everybody's offering it. It's so hot right now. Hop on the bandwagon and you'll be one of the cool kids. That's one thing. And I think the second thing is we can start to answer some really fabulous questions. And I'm trained in a finance department. Everybody's talking about arbitrage, and I came to MIT and everybody's like, let's talk about trees. And I was like, what? And so we started this project in cooperation with the Sensible Cities Lab, which was downstairs from us here at MIT, and they had a project called Treepedia. And they're like, let's look at all the trees and tree species and what's going on out there. And I was like, okay, but let's use some image recognition around what's happening, with the street level experience of humans. So you're walking down the street, you're in a neighborhood, and you're engaged with the environment, and all of a sudden you'll be in a neighborhood, there's no trees. And you'll be like, what happened in the neighborhood? It's kind of doesn't feel so good. Or you'll be in a neighborhood and there's tons of trees, and you're like, this is a lush neighborhood. I'm enjoying myself. I'm sitting on this park bench. What an amazing human experience. We felt that qualitatively, but we wanted to measure that empirically. So we used image recognition algorithms to measure the pixels using Google Street Level Images at every single 500-meter range throughout Manhattan. And then we correlated that back to commercial real estate prices. So a little bit different than what Erkan's doing in this paper. He's looking at residential. We looked at and used the lasso approach. So it's very similar sort of technique. We're trained in a very rigorous procedural approach from our PhD parents. But I would say we've used the same approach methodologically, but at the same time, we did this for
Yeah, but we lost Andrea.
The amount of street level greenness that was present at the time of the transaction. And what was fascinating by this was that this result was very robust to the amount of investment that communities were making by commercial and residential owners in the area. But it was also very interesting about the rise and the contribution to the rise of values in low-income neighborhoods. So low-income neighborhoods actually got a greater lift from the presence of trees and street level greenery than actually high-income neighborhoods. So they still got a lift in high-income neighborhoods, but they got a bigger lift in these low-income neighborhoods. So after we did this analysis and we did all of our robustness checks and our modeling, we were like, plant some trees, people. Because that goes at the heart of the environmental and the social and the health issue that we're all facing, especially during this pandemic. We got to get outside, and we need that experience to be as equal and as healthy as possible. And the issue was we don't have a lot of trees. And so now I walk through a neighborhood and I pay attention to trees. So coming back to what Ali and Erkan are saying is, we could definitely use some more data scientists. Actually, we could use hundreds, if not thousands of them in our industry. So we've got classes available. Learn it, do it, apply it. It happens late at night. It happens everywhere. But we're getting lots of value out of it. So what Ali was saying, we're getting lots of value in learning about what's important for our industry. We don't make fun of me with trees, plant more trees. It's actually valuable for your asset, and it gives you a 5.5 to 6.7% premium in your rents. So do it, plant trees and help save the earth. We've got like 6 years left, so.
So we'll continue on with some ESG flavors, and I'll go back to you, Erkan. I know you're also doing some work using the data science techniques of natural language processing and playing through that way to understand the applying machine learning on ESG disclosures from real estate companies. So tell us a little bit about the type of practical application, once again, that you're using a different aspect of ML to be able to get alpha.
So, Bruce, this was a project that we developed for European Public Real Estate Association. I think that's a good example. I want to add to what Andrea said as well. Like, for instance, actually, the idea was Ali's. Ali came with the idea to me, and he said, like, Erkan, there's this idea. Can we look into the company reports and do some analysis? And, can we create some kind of a CapEx measure for each company and dollarize the environmental impact? I think that's a very good example for collaboration between academics like us, Andrea and me, and people in the pension fund industry, or people like Ali. So I think that was a very good example. So Ali had this great question in mind, or great research idea in mind, and we came up together and we did this research. So what we see there is that one important thing that I see is like EPRA is seriously great about trying to standardize the ESG reporting, especially related to carbon impact, waste generation, and all of other social aspects. But there's still a very big problem. I think that's the major challenge here that I see when I work on the European public companies, and this holds for everyone. And I think maybe Europe is doing great here. So there's so much of a bigger problem here. And how we benefited from data science or these intensive models like machine learning models or the keyword approaches, we kind of tried to correct the data. So we have some examples with great reportings that is useful for the audience or for the investors to understand what's going on with the company and their activities related to decreasing carbon impact or decreasing the social impact, but not for some others. So using those ones reporting well and using some keyword analysis and so on, we first try to identify the words that are kind of measuring or capturing those ESG activities better than others. And using those data set with more complete information, we try to predict the ones that have missing information or incomplete information from an investor's perspective. So we use there some kind of machine learning techniques to kind of standardize the data, at least maybe to complete the standardization in the market, we use those techniques. And I think it worked well. So, and then we converted those into kind of dollar values to reflect that. For instance, if one pension fund invests $1 in a REIT, how much of that $1 will go to ESG capex or ESG spendings or ESG benefits? So that's kind of the target of the project. So as I said, like we need standardization, we need communication. Definitely we need communication between the academics and the industry, because I mean, we definitely need much more to do about standardization. Data science can help a lot here. So I think we can definitely benefit from those models. Textual analysis is very precious. I mean, there's the information. Some do better reporting than others. So we can benefit from those companies that report better or more transparent, and we can try to understand what the others are doing as well. So it's very common, for instance, in the fraud literature. So they look at those languages and try to predict a fraud, but we can do it in a good way. I mean, we can try to predict what good things they are doing by looking into those tags and using textual analysis. Yeah.
So continuing on the theme of climate, I'm going to go back to Ali. As in, you mentioned climate and stranded assets, things that are at risk. As in, how are you looking at the real estate market and the vulnerability to climate change?
I think just to add on the discussion, like for example, greenery improves the value, and a lot of the ESG metrics that are not captured effectively in a standard way also seem to get lost. So I think what overall data is helping us do is get a better picture. It's increasing efficiency in a traditionally inefficient market. So in terms of climate risk, first of all, we are now much better at understanding where the risks are, and once that is visible, then you can take precautionary steps, and you can take long-term views as to where to develop, how to develop, and so on. But generally speaking, I feel that the data, what I see in the discussion, is starting to internalize some of the external costs of doing business in real estate, which were previously not noticed and not reported in a way. So any economic activity, we are very good at knowing the direct cost of it, but the indirect cost of environmental impact, for example, we are a lot better now in capturing and understanding what the impact is on an asset level. So that allows you to become more sustainable from the operations side of things. So I keep on going to company or sector specific examples because that's where I see the most tangible evidence. So one of the best performing sectors of the last 2 years is storage REITs. So where you can store your goods for short term, and the leading companies on that sector are say that something around more than 75% of their incoming customers are through internet search, which is very customized as to understand using data, who's moving, when they're moving, and then offering very sort of, it's going as far as being able to offer individual specific lease contracts. So this smart contract allows them to tap the demand. It's sort of a price differential that they use. So that is going back to their operational efficiency that was unimaginable 10 years ago. In terms of climate risk, I think big data allows us to view what the impact is, allows us to capture it much more effectively, and then it leads to introducing practices that allows us to minimize those kind of climate impacts.
So we've digressed a little bit from the data science aspect. I might try and pull it back and talk a little bit, shall we say, some of the more innovative data sets that you have. So Andrea, I'm going to pick on you again with some work that I know that you've done. You've done analysis on daylight, as in the amount of daylight that some properties get with machine learning. Can you explain how that where that came from and what sort of results came from that?
Yeah, so to build off of Erkan and Ali again here, and to answer your question, I'm going to get to daylight, but hold with me for a second. So to be able to answer a question about daylight, we've got to do some data science integration. And that means we have to take the concepts of big data, which are incredibly important and have been put to the frontier by the fintech industry, by the healthcare industry. But our sector, real estate, which is $120 trillion sector around the globe, we've got what we would call wide data. We've got lots of features. So in machine learning language, we're feature heavy, not outcome heavy. We've got like 2 or 3 like major outcomes that everybody's talking about. Rents, prices, ROI, but cost, ooh, if you can get it, ooh, sexy. But what we've really got is a lot of features, lots and lots and lots of features, and they're incomplete. So Erkan's talking about this dirty data that he's got to go through with this textual analysis, and he's like, some are short and some are heavy, and it makes you think that there's this unevenness around sustainability, but actually just some people just don't know how to write. And so what ends up happening is that what we have is this sort of very incomplete panel of what our experience is. And so as we get more digital acumen in real estate, I call this digital acumen. So the buildup, the resilience and the strength around actually collecting that data, maintaining that data, building up that data. And we've done a lot in the past 20 years. By God, we didn't have much 20 years ago, but now we've got a lot more, right? So we're building up, we're coming out of our, I would say, our preschool days. So we're not even in elementary school yet, according to the long trajectory of data science that other sectors have gone through. So we're coming into preschool and we've got a lot more to do. And we've got a lot more to do because we've got a special type of data. It's wide data, and it's got to be integrated in a geospatial and a geometric and geotemporal, and a temporal format. So we have a geospatial, geometric, relational space that we need to build out. So here at MIT, at the founding of the Real Estate Innovation Lab, I said, we need an engine. We need to have something that we can have a sandbox that we can play with. So we created this world where we created the geometry of a city. We literally took that geometry and we plugged it into where it is geographically in the world. And then we sat it on top of this massive database so that we could able to answer questions like trees, awesome, but also things like daylight. So we had to sort of say, okay, I don't observe empirically daylight all of the time, but I can set up the simulation conditions. So we have a lot of tools that we've got to bring to bear in data science. So ML is super important, especially when we're doing natural language processing and image recognition. Maybe we can't leave some aspects of our simulation behind because we haven't learned quite yet, or we haven't quite mastered the big data sensor recognition algorithms yet to capture, say, daylight throughout the day in mass. So in place of that, we need the simulation work to be done. So utilizing that geospatial, geometric, relational database, we did that for all of New York City, and we followed that city for 20 years straight. And we have, God, I would say 1,500 variables for every single building in Manhattan over that time period, with various degrees of completeness of that panel. But in doing that, what we're creating is that architecture of where we want to go in terms of that data, and then layering in these features that we know from an environmental, social, and governance framework, what we need to level in. Daylight is incredibly critical for our human experience. Without daylight, we go loopy. We lose all sense of time. We lose all sense of experience. We lose all sense of productivity. It's actually critical for us to actually have daylight. I didn't understand it until I really dug in with our team to write this paper. So for our health and well-being, we need daylight. And what we learned from our study was that actually there's an absence in daylight, particularly in Manhattan, but for a lot of cities, there's an absence of daylight in Northern Hemisphere cities. Toronto, I'm sorry, guys, you guys also struggle with daylight.
Yeah, we need our vitamin D coming up.
Vitamin D, right? So that's a premium commodity for you. And when you don't have that daylight and you don't really pay attention to it with your architectural design, if you don't do that daylight analysis with your architect, then you do that at the financial performance peril of the lifetime of that asset. Because I can't resituate that building for you once it's up. And so working with the architects and the building technologists here at MIT, what we discovered very, very quickly was the financial performance of daylight it's a long-term value. It's a compounding value asset. So what we wanted to do was sort of say, look, pay attention to your daylight, pay attention to your views. I mean, it's not just an amenity, it's actually like a part of your mental health. Pay attention to the trees. I mean, you can talk to Ermak. I never thought I would, Erkan, I would never thought I was going to sort of talk. Actually, on the Turkish, and she's brilliant, just like Erkan. But I think the idea here is that what we want to do is create this environment where we're expanding the data sets to think more about our asset class. Our asset class, it's not in necessarily in documents. It's a living, breathing thing. It's geometric, it's geospatial, it's relational, and we need that.
Yeah. So expanding the data sets actually is one of the questions that have been coming from the audience, and I'm going to fire it to all three of you. And the question was, in my experience, the data completeness, granularity, and the analytic techniques aren't always in lockstep, just as you just mentioned there, Andrea. So especially for emergent topics like ESG. So they were after the panel's view, what data enhancements would provide the greatest impact for the analysis going forward? So thoughts from all of you. Erkan, you're first up.
Yeah, I mean, like from a reporting perspective, I think Andrea did some research there. I did some research on certifications like LEED, Energy Star. Actually, that's how we started our PhDs as well. But I think it's moving towards more understanding carbon emissions. I think carbon is everything here, right? So we need to decrease the carbon emissions, and I think we need more direct information related to carbon emissions based on the usage of the real estate assets by the tenants and by the owners. So that's what we need. I think that's the next level, especially from an institutional investor perspective, that we really need to know the carbon emissions. And the problem I see in the data is and that's where the confusion comes from the real estate industry. The tenant usage. So who uses the space? So companies report this, but the space is used by the tenant, and there are some contractual limitations here to know about the exact emissions or usage in the property. So some companies report their emissions, ignoring the tenant's emissions. Some can get the data from the tenants or collect the data, and they can report the emissions from the tenants. I think that's where we need transparency. And there's the scope 1, scope 2, scope 3. They're very confusing from a perspective of an end user, data user. So like there is no standard there. We seriously need to know the carbon emissions of a building, and we need to know more about how the properties are used. And I think we need more transparency there. And I think that's the way I see. So right now, that's kind of the research I'm pushing forward.
Carbon emissions from Erkan, and I got to admit, I'll throw in my 2 cents worth on that one. I think the piece of data that would be interesting is a granular level of energy usage.
Yeah.
That not only for the positive impacts, but also for able to be able to catch, so I say, nefarious activities. You can also pick up from granular energy usage information. Ladies next. So Andrea, what magic wand piece of data would you like?
So when people come to me and they say, we're going to measure E, S, and G, and then they start doing E, and they're like, I've got E. E feels good. S, oh, I've got some social stuff. I've got some health. I've got some social inclusivity of ethnic backgrounds, religious diversity. Okay, we're getting there. And then when they get to G, they're like, G. What do we do with G? What is governance? What does governance mean to us? What does transparency mean to us? So I want G scores. I want us to come up with G metrics, and there's a lot more data that we can do that, but just simply what can we understand from a building? What do we even know about it? I think is a great place to start.
So give me an example of what a G score would be.
Yeah, so in commercial real estate, there's a lot of ownership that's intransparent. It's owned by shell companies. We'll break through that shell, like for example, and then from that, actually, I know very little about who's in that building. I can't actually stack the leases in that building. I don't know who enters and exits. I don't know. I mean, so if I had to buy that asset and do the due diligence on it, it gets really hard. So the G's tough. And G, we know, is a great, important predictor of democracy, inclusivity, social well-being, social efficacy, health. It's
fascinating. Ali, your magic data one. What would you pick?
So in my case, inevitably, I have to align my views with the users of the index who are typically investing across the globe or a sector. So they're looking at hundreds of companies. So what would be the key from that perspective would be the data that is standardized that allows fair comparison across from company to company. And it captures the efforts as accurately as possible. How you compare a company that is placing solar panels versus someone supporting a school initiative. There must be a way to rank those two companies in their ESG performance. ESG metrics are going to change. Good governance, bad governance would be debated, but the data that allows to compare one company to the next, despite their different business model, would be very valuable.
Now, this has been a fascinating discussion here amongst us, but we are coming close to the top of the hour, so I'd like to take this moment to just say thank you to Andrea, Erkan, and Ali for all your great insights and this wonderful conversation we've had. You know, the experience and insights, and hopefully that's enlightened the perspective of data science and just data usage all up for the real estate investment. To all attendees, thank you for your participation today and your engagement, which has contributed to this rich discussion. We thank you all for joining us at GRI this afternoon, and we look forward to seeing you at other GRI events. Goodbye for now.
Thank you.
Thank you.